Welcome to another installment on this YouTube channel, and in this video I will be introducing to us the concept of liquidity. And before that, let us do a quick flashback. When I was a new trader, when I started trading for the first time, I would be wondering, why do price move from a particular swing point to another swing point, just as price moved away from here to this low, and why did price turn from this low to this high? Now, before now, I do believe that these are just buying and selling pressure, where buyers, a large volume of buyers or bulk of buyers came into the market to move price up and down, and for the sake of price going down, that should be the sellers driving price from the high to the low. So I believe that sellers are coming into the marketplace from this high, then price moves down, and then they are selling it to the buyers that are willing to move price away from here to here, and also from here to wherever price is going. Now, that was my myopic understanding on how price moves and the reason why price moves. I believe these are the result of buyers coming into the market and sellers coming into the market. In other words, buying and selling pressure. Until I grew to understand that this market doesn't really respect those logic or those ideas. This market doesn't really move as a result of buyers and sellers coming into the market. This market actually moves as a result of the concept behind liquidity. Are hearing liquidity for the first time, or for those that doesn't know what liquidity means, liquidity simply means money. It is the ability of an asset to be easily bought or sold. Mark the word easily, quickly. So in other words, it is the flexibility of an instrument or an asset to be easily converted to something else. Take for example, in a real life, you want to sell a phone and you want to get a laptop. Now, without money, you resort to the idea behind trade by barter, where you change goods for goods and services for services. If you adopt the idea behind barter, you won't be able to measure up the value which for the phone and for the laptop which you want to acquire. You want to sell your phone and you want to acquire a laptop. Now you see there is a difference in value between the phone and the laptop. So with the help of money, you can match up the value for that phone and for that laptop, and you can be able to pay for them or sell them with the value which money provides. So this is just too much grammar. What I'm trying to say is liquidity is money, and money resides at every swing high and every swing low in the market. So whenever you see a swing high or you see a swing low in the market, it is a potential liquidity pool. Just like we see this swing high here and the swing low here, they are potential liquidity pool. So just as you can see, price moved away sharply from this point, from this zone, from this area. Now retailers or the less informed traders or the new traders that are less informed would see this as a resistance or as a place where market sold off from. So that area is fresh. They will expect price to come back to that area, then sell off again. This is the idea behind trade. These are just what happens or what goes on in a trader's mind. They believe that once price moves away from an area or a zone, that zone is fresh. Price is likely to come back there and continue the same direction. I here for the fourth time will believe that this is a strong support. They are going to place their sell stops below this area, or their stop loss below this area. So when price is coming for the third time, for the fourth time, price is going to reverse just like this from here, and price shouldn't break below here. Just assumptuously, you place a buy position here, your stop loss is going to be below here. So traders who believe this is a strong support and they would like to buy off from this zone, which actually price didn't reward them for the fourth time. Now liquidity has been built below this area as a stop loss order, that there are some traders that would like to sell once price break below here. They will see that, oh, the price is bearish, it is selling, so they wouldn't want to place a buy position. They believe they are smart, they will want to only sell, so they will want to sell when price breaks below this support. They will place their sell stop just a little bit below it, and look what price did. The market actually triggered them in. Now they are in profit for a while, and the market reversed. It went contrary to their wish. So you can see that the idea behind this liquidity is just like money being printed below here. Okay, there's so much money below here, so our market is going to move to wherever the money is. Okay, now if you look at this high here, price moved away from this high. Okay, price moved away from this high. Now those that would like to see this as a resistance will say, okay, this is an impulse move, and whenever price comes back to that area, they are going to place more positions and sell off again. So they are going to place their sell, and their stop loss will just be above here. Now the market rewarded them for a while. It came back for the second time, rewarded them again. Now they will believe that this is a strong resistance and it's going to hold price for a long time. Okay, so many traders that are already selling from above, probably from here, they will see this as a strong resistance. They are going to move their stop loss just above here. They're going to place their stop loss just above here, and you can see what price did. After price dropped the liquidity below here, deep into the liquidity pool, price reversed, and those that would like to place more sell or move their stop loss got stopped out. See, so many liquidity have been built around this area and this area. These are liquidity zones, and price will always go to wherever the money is. This is the idea behind liquidity. So just as price has come here, tapped into this liquidity pool, moved away again, this swing high as well is a potential liquidity zone. In future time, price could come and sweep above it again, trade above it, grab every liquidity that is resting above this high. So every swing high and swing low is a potential liquidity zone. So just know that price doesn't move as a result of buyers coming into the market or sellers coming into the market. Price move as a result of money being printed at every swing high and swing low in the market. And you should know that wherever you see a swing high, there are potential buy stops above there, stop loss, and whenever you see a swing low, there are potential sell stops below there or stop loss orders. So and price is going to only go to where these orders are, and you know these orders are people's money residing above and below this area. Price can only go here to clear those money in order. This is just the basic reason why price moves. Price moves in order to clear out the money that's left above or below the swing high or low. So since I have established the understanding that liquidity resides at every swing high and every swing low, it is not limited to one time frame. It is the same in every time frame, from the 1 minute time frame to the 1 hour time frame to the daily time frame to the weekly time frame to even the monthly time frame. Liquidity resides above every swing high and every swing low, because price will eventually in future time trade to those areas. Okay, and this is the reason why price moved from this high to this low, from this low to this high, from this high to this low, and so on and so forth. So it is not limited to just the 1 hour time frame. Let me scale down to 15-minute time frame so we can spot the liquidity that we can see. So whenever you see a swing high and a swing low, just know that that low is a potential liquidity zone. There are ways that as a smart money trader there are so many methods we use to decipher or discern which particular liquidity the market will likely trade into, and I'll be discussing that. So as you can see, price moved away from here impulsively, created a low, okay, created this low right here. Now since the market tends to be bullish, remember we are backtesting this in hindsight, but without hindsight data we won't be able to understand what price do or what price does not. So stick with me. As price moved away from this swing low to this swing high, made a minor retracement, this particular swing high becomes a suspect. Okay, right? Market move into it, grab every liquidity, because there are some traders that would like to force their will on the market. They would like to sell. Okay, once price tends to move down or shows a signature that it wants to go down, they would like to sell into it because probably they have looked from their 1 hour time frame and see this strong bearish movement. So they believe that once they scale down to a lower time frame, they can immediately catch the next swing high that is going to drive price lower. Okay, so when price retreats, move to the upside, it grabs every liquidity that rests above the swing high. Okay, price retrace. Okay, now immediately price retreats, this high becomes another suspect for price to trade into. Price eventually traded into it, grab every liquidity, and so on and so forth. You can see I'm just trying to establish in your mind that liquidity resides both swing high and swing low. You see, as price is moving higher and higher, creating higher highs, creating higher lows, these swing lows also are potential liquidity zones. Yes, price is not taking them out yet, but price will eventually in future time come to clear out every liquidity that rests below the swing lows, and which you can see price eventually did. It traded down to clear those liquidities that are resting below the swing lows. Okay, all the liquidities that are resting below the swing low, the swing low, the swing low, and this. And before price cleared the swing lows, it made sure that it cleared all the swing high here. This is the swing high. Market cleared the liquidity there, it dropped again, it cleared the liquidity that is above the swing high here. Also you can see cleared it. Okay, we also cleared the one here. Okay, and left another liquidity pool. When price begins to drop immediately, when price begins to drop impulsively, traders would believe that okay, this is a strong resistance, because it was where price drive, it was where the market was driven to the downside in the most to clear out this liquidity. They will believe that this is a strong resistance. When price comes there, they would like to sell again, and you can see price eventually came there. Okay, let me clear out this. The market came for the first time. Those that would have their entries just above here wouldn't get the fill, or if you scale down to a higher time frame, you might get the fill into your order. So Now when price trade into it, price failed to break above here, it dropped for the first time. Now this has strengthened their confidence to sell the market whenever price comes up there again, and we can see price eventually came for the second time, filled them in. Some are having their stop loss here, dropped impulsively to the downside. Now those that are selling here will be proud of themselves and they will say, okay, the concept behind support and resistance is valid and it works. It's the market sometimes rewards this logic, this retail logic, in order to keep them in the game, to make them feel welcome. But at the end, they are creating loopholes for them where they will fall into and they will grab all their money. See how price rewarded the sellers here handsomely. Okay, price rewarded them handsomely here, and they will establish that notion within them that this is a strong resistance, and whenever price comes there again, they would probably like to take it out, or they would like to place more entries with high leverages. And look at what price did, and they will place their stop loss just above this high here, just above the high. Okay, the red line is the stop loss, and look at what price did. Those that wanted to scalp could have gotten rewarded, but those that would hold their trade for long get stopped out. Okay, and those that believe that this is a strong resistance would get done. You can see those that would believe that this is an impulse buy, this as market is making higher highs, higher lows here, so want to continue the buying that the market has already established here. Some would believe the idea that this is a strong resistance and they wouldn't want to buy yet. They will wait for price to break above the resistance and they will place their buy stop just above it, and when price breaks above it, they get their fill and price would hopefully continue to the upside. But unfortunately for them, price fills them in. Some will have their stop loss below this low or below this low. Price filled them in, came down impulsively, stopped those that have their stop loss here, those that have their stop loss here, stop every one of them out. This is basically what the market do, and every new trader should understand the concept behind liquidity. If you can understand that liquidity resides above every swing high and every swing low, you will trade cautiously and you will want to trade in sync with the bank or the algorithm that controls price. So this is it. This is Liquidity 101, and I'll be hinting more on liquidity in the next video. Do well to like and subscribe to this channel, share the video, and toggle the notification bell so you can stay posted when I post other videos. Be safe, happy trading.